Bill and Terry, good afternoon. I hate that we couldn't find a time for both of us to meet in person, but I really enjoyed meeting you both a couple weeks ago, and I'm happy to report that I have a plan. I'm making this video to supplement for our in-person meeting to basically go over what's in this, a brief overview, and what I will do is cover all three sections. I take a look at your current situation with some analysis and some data that I've compiled. And then I kind of discuss your goals that you mentioned to me, and then I move into my recommendations on how I think you can best achieve those goals, future goals, retirement goals, etc. So let's begin. First off, I just want to say you both have an amazing, very lucrative gross pay, so of $170,000. So I think any issues that I have identified and solutions that I've come up with are going to be no problem to implement, given your gross pay and, as you can see, your net discretionary pay after all expenses in my budget. But taking a look at some of the balance sheet items, some of the issues I have identified in your balance sheet as of March 22nd, page 4 has that balance sheet. But the main issue I see in your balance sheet is liquidity. And I have included some neat little pie charts on the bottom of page 2 and the top of page 3 that show what your current asset makeup is and what I believe should be the target goal. So currently your current assets only make up 2% of your total assets, and that is solely in the form of cash in your checking account. You have no other cash or cash equivalent accounts. I would like to see current assets be more closer to 10% of your total assets. That's really where we want to head. In 2 years, with the plan I have given, you'll be at about 5% current assets. And then taking a look at the other side of the balance sheet, your liabilities and net worth, there are a few issues I saw here, and again, it goes to current liabilities. And that contributes to liquidity, because liquidity is simply the availability of cash or cash equivalents. And it's essentially, you can measure it in a couple of ways, with the current ratio, the emergency fund ratio, and other ways. And it measures your ability to meet short-term obligations, and that's what current liabilities are. And that includes credit card balances and any other debt payments that are expected to be due within the year, 12 months or less. So that includes your mortgage payments and your auto loan payments, principal payments is what is included in that. And currently, your current liabilities make up 8% of your liabilities and net worth side of the balance sheet. I would like to shoot for closer to 5% on that. And we'll actually probably surpass that in a couple of years, because what I really want to do is eliminate your credit card debt. You have a substantial amount of credit card debt, over $28,000 on the balance of those over 4 cards. So in my plan, I plan to reduce that, because it can be a dangerous thing, that interest. Nobody should be paying 10 to 20% interest if you have the means to avoid it. But taking a look at the current ratio, your current ratio, which is just current assets divided by current liabilities, is currently 0.25, which is much too low for comfort. You really want it equal to 1 or greater than 1, which means the ability to meet all short-term obligations if necessary, or if they were all to come due at the same time. And then taking a look at the emergency fund ratio, it really measures how many months that you would be able to pay your mandatory expenses, the things that you have to pay, your bills, your food, your gas, clothing. How many months you can pay that should you go without income, or that your income would be significantly reduced. Currently, your emergency fund ratio, which takes current assets divided by non-discretionary cash outflows, so your mandatory expenses, currently it's 2.69 months. That's how many months you would be able to pay your mandatory expenses if your income was reduced to zero. Typically, a minimum of 3 months is standard and considered sufficient liquidity for that. But like I said in the report, I don't expect you, Bill, to lose your job anytime soon as a tenured professor at Arkansas State. So you have a relatively stable source of income, and you have 3 different incomes, with a credit union job and then Teri's job, of course, at Arkansas State. But I'd like to see that number increase nevertheless. Other emergencies could occur, injury, something else could happen. So you want, overall, I think your liquidity is not sufficient, specifically looking at the balance of current assets to current liabilities. That's really the root of any problems I can identify in your balance sheet right now. The rest of the balance on those, as you can see in those pie charts, are pretty close, and over time, will come more into view, especially just by simply dealing with those current assets and liabilities. As I said, the balance sheet I have for you is listed on page 4. That's some good information just to be able to see. A few other ratios that commonly are used to measure how well a client manages debt are that second housing ratio and total net worth to assets. The second housing ratio combines basic housing costs, so that's principal payments, interest, homeowners insurance, property taxes, and it combines all of those with other debt payments, so your auto loans, credit card payments, etc., and divides that by gross pay. The result should really be equal to or less than 36% is what we're aiming for. And after doing the calculation, $54,222 for all your debt costs plus all housing costs, divided by your gross pay of $170,000 comes out to be just shy of 32%. So what that tells me is that your income is enough to comfortably handle the amount of debt you currently have. But like I said, I think your current liabilities, especially your credit card debt, can be and should be reduced. So we'll get more into that in the recommendations section. Your net worth to total assets ratio is currently 55.7%. As you can see in the pie charts on page 3, should be closer to 60%, but you're almost there. And really, when you deal with those current assets and current liabilities problems, that will be closer to 60%. And then, of course, that ratio should increase over time, and I would expect by the time you retire that ratio of net worth to total assets be closer to 80%, because you really want little debt by the time you retire. Now, turning to another subject, saving. I think you both are doing a good job. However, it could be even better. Along with each source of income that you have 3 great opportunities for retirement investment. Currently, you're taking advantage of 2 of those 3 employer matches for your retirement accounts. You currently do not take advantage of the 1-to-1 up to 4% match that the credit union could provide Bill. Currently don't take advantage of that, so we'll look at that in the recommendations. But with the employers, currently with the 2 that you do utilize and take advantage of, with those matches included, a total of $25,400 every year, or 14.9% of your income is being invested towards your retirement. That is pretty good. That's about 15% of your income is being saved, including the employer matches, towards retirement. So, like I said, you're doing a good job, but I think it could be even better, and I think you should strongly consider taking advantage of that match at the credit union. And then, we take a look at some traditional benchmarks for investment assets. So at 47, you both are 47 years old, you should really have about 4 to 5 times the amount of investment assets than you do gross pay. And looking at your total investment assets of about $242,000, you divide that by your combined gross pay of $170,000, that comes out to be 1.43. So definitely not even close to 4 or 5 times your gross pay. But you do have a large gross pay, and but we'll take a look at that. On the next page, on page 6, you'll see the expected income statement I have for you for 2018 with recommendations. So that's very helpful. I encourage you to take a look at that. Next, I just go through some of the goals that you discussed with me in our meeting a couple weeks ago. You talked about how you enjoy what you do, but you want to retire at age 65. Upon retirement, you want to move to Eastern Tennessee into a small cabin. I think that's a great idea. The cost of living in Tennessee is about the same as it is here in Jonesboro. The state doesn't have an income tax, the state income tax, so you won't have to pay state tax on your retirement disbursements, so that's good news. And I outlined some more details about the cost of living in Tennessee compared to Jonesboro, Eastern Tennessee, that is. And then I go through talking about the cabin you want to buy, $90 to $105 a square foot, so we can conservatively estimate that the cabin will cost you about $105,000 unless real estate, really increases over the next 18 years, which it could. But we'll go ahead and say 105 on that. And you mentioned, Bill, that you want to make sure that Teri is properly cared for should you pass away before her. So, that means life insurance is important to you. And currently, you have policies that would pay a total of $340,000 if you passed away today while you're still working. So that's a lot of money. The question is, in retirement, what policies would you have, and would it be sufficient to cover expenses for Teri should you pass away? And I think that really depends on whether you can keep that additional estate policy that you're paying towards every month. And I think, if you're able to do that, you continue paying that premium, and that will likely be sufficient, $200,000, 2 times your annual salary on that one. And, another thing you're both passionate about is travel. Not only do you want to travel several times in retirement, you want to set aside at least a $25,000 endowment scholarship for A-state students. I think that's great. You'd be enriching the lives of a new generation of college students, and that's really special. And I've also, since you enjoy travel so much, I've actually budgeted $10,000 a year for travel while you're both still working. So in 2018, I budgeted $10,000 for you to take trips every year while you're still working, and this year included, because you should have sufficient cash flow to do so. I think if you take a look at the income statement, you'll see that. Now, finally, moving on to the recommendations. This is really the meat and the plan, the meat of the plan that I have provided, and I think I hope you find it helpful and easy to understand. The first thing I talk about is balancing that balance sheet. Like I said, we want to control the current assets and current liabilities compared to the totals, because that's kind of an issue. So I want to not only boost your cash and your cash equivalents, meaning current assets, but I want to decrease your current liabilities, which really means eliminating your credit card debt. Like I said, no one should be paying 10 to 20% on balances on your credit cards. I mean, that is just crazy if you can avoid it. And I understand that you usually just make the minimum payment of $25 or $50 on your credit cards, and you just leave the balance to grow with interest that you'll have to eventually pay, which is can be really dangerous, and which is why I'm recommending that you decrease the balance of your credit cards. And I actually budget in 2018 that you pay down the entire balance of $28,822.17 by the end of 2018. I think it's vitally important that we get rid of that credit card debt. Now, credit cards can be a great thing, if managed correctly. And I think you should probably close, once you decrease those balances, that you close one of the 4 cards. I mean, 4 is kind of too many. And then, after you do all this, what I'd like to see happen is that, or what I would recommend to you, is that you open a checking account that pays you for making purchases. So instead of making the bulk of your purchases with your credit cards and having to pay them interest on those, you can have a checking account, make the bulk of your purchases with a debit card, and get paid. So, for example, Southern Bank in Jonesboro has an account, the free Casasa Cash account, which pays 3% interest on balances up to $15,000. So that means you could potentially be receiving $451, 450 roughly dollars in interest per year just for having this account. The only requirements that you have to have are 12 debit card purchases each month and at least one ACH or direct deposit each month. And you also have to be enrolled in e-statements. Now, this is not my recommendation that you open this particular account. It's just simply an example of one that would be good, I think. So instead of paying interest to make all these purchases, your typical purchases with your credit cards, why not have a bank pay you interest for using your debit card and reward you for that? It's really a great account that I recommend you if you opening. And if you have strong ties to your current bank, I think you could probably still keep that account open, but transfer most, if not all, of the cash over to the new one. And in addition to your checking account, I want to see your overall cash increase. So to do that, I'm recommending that you open a general savings account that pays at least 0.5% of interest. Savings rates are very low right now, cash savings accounts. So at least 0.5% interest is what we want to look for, and just something. And I recommend that you start saving 5% of Bill's A-state salary. So that would be $5,000, 5% of $100,000, towards this savings account every year. So at the end of 2 years, you should have at least $10,000 in there. The reason for this account is mostly for risk management purposes. Should you have an emergency and need to cover those extraordinary expenses, that will boost your liquidity. And then you take a look at all these changes, assuming that your cash increases to a minimum of $25,000 from your current $9,800, assuming that your cash increases to $25,000 and that your credit card balances decrease to below $2,000, that would bring your current ratio to 2.05, up from 0.25, which is a dramatic increase, and that's great. I mean, a current ratio of 1 or greater is good. A current ratio of 2 is fantastic. It would also improve your emergency fund ratio to 6.85 months from 2.69 months. So that means you would be able to pay almost 7 months worth of mandatory expenses should your income be unavailable. The next section I look at is saving for retirement. So the first thing, before I get into the specifics of this, I think you should see an attorney and discuss with them on setting up a trust for your assets. I think that's really the best thing to do, since you don't currently have a will, and a trust secures your assets. It will allow your beneficiaries to obtain your assets more quickly than an ordinary will, and avoids probate court usually, and attorney's fees and all of that. And I'm sorry, I've got an update on my computer that I'm closing out of now. Okay, we're still rolling. Good. And now, like I said in the first section, you currently do not take advantage of that match on Bill's retirement account at the credit union. I think this is important to do, since an employer match is essentially free money that you shouldn't pass up. So I'm encouraging you to take the full 4% and save that towards retirement, getting the 4% equal match on that. And if you include my new recommendation to save the 5% into a cash savings account, and this recommendation to utilize the match from the credit union, that will increase your total annual investment towards retirement to $33,600, or 19.8% of gross pay. That is a great increase, and I think that will only benefit you long term by boosting those investment levels. I think you will be more comfortable in your liquidity and in your retirement investment. So excluding Bill's retirement annuities, I have a table that shows a conservative estimate of what your ending balance is in those other two, or those other three accounts, I should say, Teri's retirement account, Bill's retirement account at the credit union, and this new cash savings account. I have a table that shows what the future value of those accounts will be, assuming a few things, and you can take a look at the details of that. Basically, just to summarize it, those three accounts, once again, excluding Bill's retirement annuities, those three accounts will have grown to a total of $785,000 plus. That's a conservative estimate. That's assuming that neither of you see an increase in your salaries, so it's very conservative, and also assumes that you continue to contribute the same amount each year towards those funds. Adjusted for inflation, 3% inflation, that total comes to be $461,540 in 2018 dollars. So still a good chunk, even after adjusting for inflation on that. Now, as for Bill's teacher retirement, you have two options. Option A, I've outlined both options in a table here on page 10. Option A will pay a higher annual payment annuity of $56,700. However, it will only pay until Bill passes away. Option B pays a lower amount at $44,550, but will pay until both of you pass away. So whichever is the later of you to pass away, that annuity will be there and you will have it no matter what. So you can, go through how I weigh my options there, but in the end, I'm recommending option B, just for that security and having that annual payment from that retirement account to come to you every year of $44,000, and that's a conservative estimate. That's also assuming that Bill, you don't see an increase in your salary as a professor. So you can take a look at that table and both of those options, but I will recommend option B on that. So if you combine the teacher retirement with the other three accounts, we can essentially calculate the annual amount you can expect to have at your disposal in retirement. So you add the annuity payment of $44,550 with the amount that you divide. You can divide the total amount from the other three accounts by a number of years to calculate how much you can expect to receive annually. Now, assuming that at least one of you lives till you're 85 years old, you will have a total to spend, combining both amounts, of $83,837 per year. So this means that you'll have an estimated $83,800 plus to spend every year until you're 85 years old. And that's not including any Social Security benefits, which, as you have said, expect to cover all ordinary living expenses, so that's great. Adjusted for inflation, that excess discretionary spending number is $27,266. So I know you want to retire. You want to travel in retirement. So if you were to travel five times a year in retirement, that means you could spend an average of $16,767 on each trip. Adjusted for inflation, that's just over $5,400 per trip. Not bad for 5 trips a year. Taking a look here, let's see what else I need to discuss with you. Of course, all of this, in more detail is in the report. It's about a 12-page report, so I encourage you to read all of it thoroughly. But taking a look at some of the other things, you mentioned that you would like to endow also a travel scholarship for A-State students, and I think that is just something really special. I would recommend speaking with a representative from A-State about the details of that, how exactly that occurs, and the policies that they have on endowing. But then I would recommend setting up some sort of account under your new trust, whatever amount you decide to endow, setting up an account, whether that be in the form of an additional savings account, a renewable CD, or similar investment account, but that you designate it solely for the endowment. And then I would also encourage you to talk to your attorney about how to best incorporate that into your trust so that it's a smooth transition when you pass away to give that endowment to the university. And then lastly, I'd like to talk about, in the report, I talk about how you will likely sell your current home and be able to purchase the cabin in Tennessee. So using a mortgage calculator and an amortization schedule, I've calculated you'll likely still owe, upon retirement at age 65, $28,000 on your current 30-year mortgage. But you will be able to sell your home quite easily. Jonesboro is a growing city. There was recent data from the Census Bureau that estimates that the population of the metropolitan statistical area of Jonesboro has increased 8.3% over the past 7 years, from 121,000 to 131,000. So the town is growing significantly, and Arkansas State University continues to grow as well and attract a lot of new young people to Jonesboro. So I think you'll have no problem selling your current home, and I would estimate that you could easily sell it for $175,000 in 18 years. So if you take the proceeds from the sale and pay off that remaining mortgage debt of $28,000, that will give you approximately $147,000 to purchase your new cabin in Tennessee. And like we said before, the cabin will likely cost you $105,000, if not a little more, adjusted for an increase in real estate, which is likely. But either way, I don't think it's going to cost you more than $147,000. So you will likely be able to pay cash for that property and not have to take out another mortgage. So that's great news. And that's basically my report. The last thing I give you is a monthly budget for 2018 so that you can immediately put these practical steps to use. The last page, on page 12, gives you that monthly budget, which the numbers are derived from the annual income statement for 2018. So it just divides by 12 for a per month budget. And it goes through each category: savings, debt payments, living expenses, and insurance payments. So I encourage you to take a look at that and start implementing this plan now. If you have any questions, please let me know. I'm so glad you've come to me with advice, and I look forward to meeting you sometime in the future. Good luck in your future endeavors. Thanks, Bill and Terry. I'll see you later.